All right, in part 4, we're going to look a little bit deeper into the common size balance sheet. We're going to start with the liability side, and I glossed over the numbers part on part 3 of this series, but we'll cover it here in the when we're looking at the common size balance sheet for liabilities. All right, so you take all the liabilities and divide them by total assets, and that gives you everything as a percentage of assets. All right, so we look at the different accounts here. Accounts payable is, generally speaking, includes the amounts that companies owe to their suppliers from inventory purchases, all right, generally speaking. And then accrued liabilities or accruals are money they owe for virtually everything else, all right? So for Home Depot or Lowe's, we could actually go in here and look at some of the categories that they actually report. We go to the balance sheet. All right, so accounts payable, accrued salaries and related expenses, $1.5 billion. Sales tax payable, $605 million. Income taxes payable. Now, income taxes payable, Home Depot and Lowe's and large corporations pay their income taxes as they go along. So generally they make quarterly payments on stuff. So they owe Uncle Sam some income taxes, but it just ain't due yet. The sales taxes payable, they collect sales tax and they only remit it in like monthly or what have you. So that's another one of the accruals that we got some money that we're holding that we owe to somebody else. We know that we're going to give it to them. We just hadn't done it yet. Deferred revenue is for these folks is more than likely a large part of the deferred revenue is gift cards. So when you go and buy a Home Depot gift card, that Home Depot receives cash and cash goes up, and then they record deferred revenue because they don't run that number through the income statement until they actually until you go in and cash it in, and that way they can match up the cost of goods sold for the item with the actual sale. So they record the deferred revenue as a liability, recognizing that there is a card floating around out there that somebody can come in and buy something with any old time now. But we could always thumb through here and see if they explain it in the notes to the financial statements. Firearms, leases, goodwill, other intangibles, debt, derivatives, insurance, net sales, cost of sales. Probably ought to edit this part out. Okay, so deferred revenue, we do the search. There we go. For products sold in store, online payments typically due at the point of sale. For services, payment is full is due upon completion of the job. When we receive payment from customers before they've taken possession of the merchandise or the service has been performed, it's recorded as a deferred revenue until the service is complete. Such performance obligations are part of the contract and expected duration. So we further record deferred revenue for the sale of gift cards and recognize the associated revenue when the gift card is redeemed. Okay, so when in doubt, that's what the 10K will tell you, all this stuff, if you read it carefully. And if not, then if you Google it, somebody else will have that information from one of the other scads of reports that Home Depot and Lowe's and other publicly traded corporations have to publish. So accrued liabilities can be darn near anything. Accruals are, generally speaking, I owe somebody some money and hadn't paid it yet. All right, the current portion of operating leases. Now remember, like assets, there's current assets and non-current assets. Non-current assets last for more than a year. Operating leases that are longer than a year in duration, like we lease a truck for 2 years or 4 years or 8 years, the next year's worth of payments on that are reported as the current operating leases, and then the long-term operating leases is the rest of it. Okay, so the total current liabilities, notice that it's fairly similar for both companies, right around 30-35%. And while the different categories are up or down a little bit, they're actually pretty similar, okay? The accounts payable is a little bit higher for Lowe's, and that probably reflects the type of property that they purchase. Long-term debt, here you're going to see a little bit of difference because Home Depot has more long-term debt. And you'll also notice that liabilities as a percentage of assets have gone up to 95% for Lowe's, 75, 80, 83, 90, 95. They're going to be up over 100% themselves pretty soon, and that's because they're buying back shares. They're just not putting it into the treasury, and I don't know what they'll do when they actually start doing that. We can see that the total liabilities for Home Depot are 106% of the total assets. That doesn't mean they're broke. All right, we looked in the other part at what the shareholders think, that each share is worth $219. There's a billion shares, so the shareholders think it's worth at least $240 billion, not -3. And that's just because accounting is based on reporting historical costs. That's why you also have to study finance, because finance is the study of what stuff's really worth. All right. If we go down here and look at the common stock and paid-in capital, these numbers are so low over here for Lowe's because what they've done is when they buy back shares of stock, they reduce the common stock and paid-in capital and retained earnings directly. Home Depot adds another line in there called treasury stock, makes it a negative number, and in the end, okay, you end up basically the same place. They just report things a little bit differently.